5 seconds to the open. You ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
Friends, welcome to you all around the world. Welcome to episode number 468 of the Follow the Money podcast. Today's episode entitled Market Mayhem, Unraveling the Recent Selloff. In segment one, we're going to unpack the recent U.S. stock market sell-off, which was a massive volatility spike that arrived last Monday that sent the volatility index, the VIX, above 60 for the first time since COVID, and quite frankly, shocking a lot of investors and traders. Today, I'm going to be providing you with 4 solid reasons behind this recent sharp pullback, and I'm going to offer some context that might not be apparent at first glance. If you're an investor or a trader trying to navigate these choppy waters right now, I encourage you to check out segment 1, where we're going to really focus on that. We're going to focus on those 4 reasons. And then in segment 2, we're going to shift gears and chart some of the latest action in the key markets. We're going to talk about the S&P 500, the NASDAQ 100. We're going to talk about gold and silver, and even Bitcoin and Ethereum. We'll cover many of the bases. We'll provide some updates and insights to help you stay informed and prepared. So stay with us as we explore these topics and more, aiming to equip you with the knowledge you need to make smarter financial decisions. Let's get started. So what in the world just happened to the stock market? If you were watching and observing the stock market last week, or you're invested or trading, you certainly noticed it. And even if you're not, you probably heard about it in the news. What in the world happened as the stock market really pulled back last Monday, August the 5th, which won't necessarily make it in the history books as one of the biggest sell-offs, but it certainly would be one that came somewhat unexpected. At least the market wasn't fully prepared for that kind of sell-off. Now, what's interesting is that since we've seen that significant downturn, we've actually begun to see the market recover, and we're actually seeing the volatility index move back to where it was before the move. So what was really behind this sell-off? Well, today, what I want to do in this first segment is I want to talk about the 4 key reasons behind this latest market turmoil and whether you should expect it to continue. So let's talk about that in this first segment. The very first reason behind this sell-off is very obvious, and that is that investors have been positioning themselves ahead of the anticipated Federal Reserve rate cut that's coming in September. That's right, next month. We are expecting at least a 25 basis point rate cut, if not a 50 basis point rate cut, at the upcoming September 18th FOMC policy meeting. Now, that means that we will have the very first rate cut since 2020. It's been a long time since we've been in this type of environment. We've mostly been in an environment where we've seen raising or interest rates rising and then staying stubbornly high. And so many areas of the market, many investors are looking for opportunities that will work out as interest rates begin to come down. And so the expectation of lower interest rates creates a new investment landscape for investors to be able to, speculate and profit. The traders will certainly be speculating on different areas of the market, and investors will be looking for opportunities to be able to take advantage of upcoming trends. So the expectation of these lower interest rates has led to what we would call a significant rotation in the markets. We began to see this a few weeks ago when we began to see some of the big tech stocks begin to take a breather. We began to see NVIDIA pull back from its recent highs. We saw Amazon sell off. We've seen some of the major leading companies just pull back a little bit. And what's been happening is we've been seeing investors rotate out of these high growth, high risk assets, not fully, but just somewhat, taking some cream off of the top, and they're moving them into safer income generating investments. We've been seeing moves, for example, into real estate, which has really been beaten down due to these high interest rates. But as interest rates begin to come down, that's helping the real estate space. For example, we've seen a pretty big surge in mortgage applications as mortgage rates are slowly but surely coming back down to earth. And I think that trend is going to continue. Investors certainly think it's going to continue, which is why we see them buying certain sectors such as real estate. Also, consumer staples have been doing well. These are companies that typically pay, especially the high quality ones, they pay dividends, like Dividend Aristocrats. These companies have been paying dividends for a long time. Whenever you're looking for income in the stock market, that's where you look. So as people are moving out of bonds, out of cash, and moving into other areas as rates begin to come down, as they reposition, they're looking for those, safer income generating investments. Utilities have also been another big winner this year as the rotation continues out of some of the higher risk, high growth areas and into some of the safer, higher income kinds of sectors. Now, these rotations are normal, but they do provide short-term disruptions, and they are necessary adjustments, of course, as the markets anticipate policy changes. We've really seen also on this topic, we've seen record inflows into fixed income ETFs as of late, as investors, again, are preparing for those rate cuts, which is going to do what to bond prices? It's going to cause them to rise, right? High yields and the prospect of falling rates make bonds more attractive. So for many of those who have been on the sidelines, there's currently $6 to $7 trillion of cash sitting in money market funds and in similar cash equivalent accounts. And that money, much of it has been parked there because interest rates have been elevated and people have been able to get higher than usual interest rates. But as those rates begin to come down, the opportunity cost of keeping that money in these kinds of instruments is going to become expensive, and more people are going to be turning to utility stocks, real estate stocks, even small cap stocks in some cases, which are really oversold. And of course, fixed income ETFs, bonds, that is. So we fully expect to see that, and that rotation is continuing to happen. So that is part of what was going on behind the scenes as the market was imploding last Monday. But that wasn't the only thing. We also had, leading up into that day, we also had a note that Warren Buffett had slashed his stake in Apple stock by half. Now, that was also a little bit jarring for the market because when Warren Buffett tends to sell his positions, he tends to either sell them out entirely or just trim them. But cutting the stake of Apple in half was pretty large. Now, the important thing to keep in mind is that Buffett still owns a massive amount of Apple. And he's raising cash in this environment, which spooked some investors as well. That also caused some reallocation and also undoubtedly some selling pressure. But Apple seemed to hold up okay after that report came out. But that was another little side note that I wanted to bring up. And you may have heard also about Alphabet and a federal judge ruling that Google engaged in monopolistic behavior over online search and related advertising. That marks the first significant win for U.S. antitrust authorities against big tech's market dominance. And so the idea of Alphabet being ruled as a monopoly, some of these big companies like Apple and Alphabet, when they get these kinds of headlines, that can also kind of spook the market. So anyway, so the rate cut rotation is the very first thing, along with some of these other ancillary headlines that came out that are pretty big. Then we also had something else going on, and that was happening in Japan. Quite frankly, the biggest culprit here out of all the things that were going on really goes to Japan. So what we saw, and this is important for you to understand if you're new to the world of finance, is that money flows to the rate of highest return, right? That's just how it works. And one of the ways that individuals will invest is they will use arbitrage. And what that means simply is that they will go and they will borrow low interest currencies like the yen, which is what we call the yen carry trade. And what they'll do is they'll borrow in a low interest currency. Again, the yen was paying practically negative interest rates. They had negative interest rates in the Bank of Japan. And this was causing the yen to be very low interest. And so what would happen is investors will borrow in low interest currencies like the yen, and they will invest into higher yielding assets. But because the Bank of Japan has begun to tighten and move into a place where they're not doing that, that caused what we would call a carry trade unwind, right? So the unwinding of the yen carry trade was another key factor behind this, because as these investors who borrow low interest rate currencies like the yen, well, then they're suddenly forced to sell, and that added to market volatility. So rising Japanese interest rates have made the yen more attractive, causing investors to exit positions funded by cheap yen, right? So the yen carry trade is facing a really big unwinding. And quite frankly, the yen carry trade was larger than many economists and analysts had realized. It was actually a very, very big. And we've already seen, according to some of the major institutions on Wall Street, an unwinding of that by about a good 50 to 60 to 70%. So that means that the majority of that yen carry trade unwinding has pretty much behind us. Doesn't mean we won't have more problems ahead. We could still see a little bit more fallout from this, but I think what we've seen so far is likely the extent of what we are going to see from this. And now we have rising interest rates in Japan. Now, the Bank of Japan's put the brakes on it a little bit. They're not going to raise them dramatically. Of course, that could cause even more problems here in the global economy. But as they raise interest rates, the attractiveness of that carry trade diminishes. And that prompts investors to, repatriate their funds. And that causes just a big ripple effect, leads to sell-offs in various markets. And so we're seeing the end of this long-standing carry trade as we're seeing a reshaping of interest rates around the globe. And it's just adding to market instability. So it added pressures to the global markets. It's a temporary adjustment. The way we look at it is to stay focused upon your long-term goals, of course. As an investor out there, you want to ride through this turbulence. This is a temporary thing. So first of all, the rate cut rotation that we talked about, that's a temporary phenomenon. We will see that rotation come to an end. And inevitably, we'll have more rotation in the future. But this is a temporary moment here. Also, with the yen carry trade unwinding, that's a temporary moment. So in other words, this is not a long-term fundamental structural problem with the economy causing it to come down. Now, the third reason why we saw the market sell off last week, especially on Monday, quite frankly, we can lay at the foot of the 2024 election. Political uncertainty is a bad enemy of the market. In fact, uncertainty in general is just an enemy of the market. But we have to understand that up until the middle of July, the market had been understanding the 2024 presidential election to be between two candidates. That was former President Trump and current President Biden. Now, obviously, that changed, as all of you know. Since that time, since the middle of June, we've seen President Biden basically announced that he will not be running for the presidency, will be not running his campaign in 2024, and instead has thrown all of his support behind his vice president, Kamala Harris. So while you could say, well, the market should have known that that could happen, it simply didn't price that in. So there had to be an unwinding of the Biden trade, because now we realize that Biden is not going to be in office beyond 2024. And many people had been positioning for a Biden victory. And so what they were doing is, of course, unwinding those trades and then trying to now reallocate based upon the potential election of Vice President Harris. And so remember, up until this point, the market had two different horses in the race, and now that has changed. And that, of course, changes the dynamic of what investors are expecting. So now we see the unwinding of the Biden trade and the putting on of the new Harris trade. Obviously, many people are thinking, okay, what areas will benefit in the market if Harris wins? What areas of the market will benefit if Trump wins? And that's what's going on. Those calculations are going on at the highest levels. And so the market just kind of had a moment where it just basically vomited, where it was just simply trying to catch up with what was going on. I mean, this happens occasionally. And we kind of saw the convergence of all these different things where we have, of course, the rate cut rotation ongoing, and then the yen carry trade unwinding, and then this shakeup in the election, which is really historic. The market tends to be about 6 months ahead. It kind of moves in the future, and it kind of anticipates things. And so therefore we are just kind of moving through through this election year and through this election cycle and ingesting new information as we get it. And so the markets obviously dislike uncertainty, but history shows that they adjust over time. So what you really want to do is you want to avoid any kind of knee-jerk reactions and stick to your investment strategy. In fact, last Monday, I alerted our members that I was buying more shares. In fact, I was very happy to buy more last Monday when the markets were imploding because I realized that the factors behind this sell-off were not structural. They were all temporary. So the 2024 election shakeup, that's just a temporary thing. The markets are just going to have to reevaluate the current candidates, and then we'll see kind of a balancing out there. The yen carry trade, that's a temporary thing. The rate cut rotation, that's a temporary thing as well. Now, the final or fourth comment I'll make here, fourth reason behind the sell-off before we conclude this segment, is that we would say that really what we also saw was kind of a growth scare. So this sell-off came amid some important economic data, including a jobs report. And we had basically these fears that are rising of slowing growth and disappointing economic data. And the recent economic data we've been seeing, including that disappointing jobs report, lower than expected construction spending, all that stoked fears of a potential recession. So we've been also hearing about, how slowing growth here in the U.S. economy could lead to a recession. Now, I personally don't foresee a recession in the immediate horizon, but those reports of a potential recession have been enough to shake investor confidence. After all, you really got to think about it. We've just lived through the longest negative interest rate inversion period since the late 1970s, and investors are unwinding popular trades from earlier in the year, especially in tech stocks. So the market's reaction to the economic data that may be interpreted as weaker than expected is often amplified, leading to sell-offs as investors worry about the health of the economy. So it's a classic case of market sentiment driving short-term movements, even if the long-term outlook, is still rather stable or solid. So the main thing to take away from this is that, these short-term indicators should not derail your investment strategy. The broader economy may experience a recession, but that shouldn't stop you from investing in the future. It shouldn't stop you from implementing your investment strategy. In fact, as a long-term investor, you do look for these moments where we see these kinds of pullbacks. It gives you an opportunity to, add more to your long-term investment portfolio, oftentimes lowering your cost basis as you dollar cost average. So there's four reasons, behind this sell-off. The rate cut rotation, that's a temporary phenomenon. The yen carry trade has been unwinding. That's a temporary phenomenon. We have the 2024 election shakeup. Again, that's temporary. And then we have a growth scare, which again, I also think is a temporary thing that we are dealing with. But overall, right now, as we look forward, we do expect the market to continue moving higher in its uptrend the way that it has been now for some time, albeit not straight up, and we could have more volatility as we head into the month of September. But we think by the end of the year, we'll see the market resolve higher and very likely at new highs before we know it.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
Welcome back to the Follow the Money podcast, one of the longest running personal finance podcasts online. Now, I hope you enjoyed that first segment. We talked a little bit about those four reasons behind the recent market sell-off. There's inevitably more reasons to look into, but that just kind of gives you an idea of what's going on behind the scenes. And quite frankly, all of them, as we mentioned, are temporary in nature. They're not structural. So overall, we see that the market is very likely to head higher. Now, let's talk about in the second segment, let's take a closer look at some of the technical movements across the S&P 500 and the NASDAQ and we'll even look at a few other markets as well. But let's just begin with the S&P 500, the most important liquid index, really, quite frankly, in the world, but certainly in the United States. As we look at the S&P 500, we see it rebounding from its recent sell-off. So the S&P had been trading up around 5670 or so near its high back in July, and it spent pretty much the remainder of the month, after it kind of peaked out around the middle of the month, it spent the remainder of the month just falling, and we finally bottomed out near about 5100. We have since been rebounding, and we are now right at the 50-day moving average. That's a key area, currently sitting at about 54, 55 or so on the S&P 500. We want to see a breakout above that 50-day moving average. We see bullish volume returning after that sell-off. Everything looking pretty decent here on the S&P, but we do need to scale back above that 50-day moving average. We remain in a long-term uptrend on the S&P 500. Everything remains still strong on the S&P 500. And if we look at the current action, we see about 69% of the S&P 500 stocks are trading above their 200-day moving average. That's what we would consider bullish. So overall, the markets still remain very bullishly poised. When we look at the NASDAQ 100, I like to track it. For the tracking purposes, we will use QQQ, the Invesco NASDAQ 100 ETF. Now, the NASDAQ 100 is heavily laden with tech stocks, which felt the brunt of the sell-off. And so as we see this market rebound, that tells us quite a bit, because again, this is so tech heavy. We have seen the NASDAQ pull back on QQQ from just above $500 all the way down to about 425 or so. But it caught its rising 200-day moving average and rebounded from that on massive volume. And we've been now rebounding strongly. Now we're still sitting below that 50-day moving average as well on QQQ. We want to see that broken out as well. So if you're following QQQ, that means we're watching for a breakout of above 473 or so. That'll suggest to us that we've broken out above that 50-day moving average and that things are moving, in an overall good direction. Now, we also saw the QQQ also pull back to its 50-weekly moving average before rebounding. That's another really big area of support. Good to see that happening. Now, in times of uncertainty, gold often plays a role of safe haven, and we've been seeing that here in physical gold. Physical gold recently touching a brand new all-time high, closing above $2,500 for the first time in history. And it appears that gold, may have much more upside ahead. Another 20% from here higher, which is what we've already seen in gold this year alone, would put us at 3,000. Now, I'm not expecting another 20% this year, but I am expecting over the next, 12 to 18 months, we might see another 20% tacked on as the dollar begins to come down. But overall, we've had a banner year so far in 2024 for gold. Again, up about 20% so far this year, sitting at around 2,500, just slightly below it as I'm recording this on Wednesday, the 14th of August. As we look at gold, the main thing that I'm looking at here is support at the rising 50-day moving average, currently at about 2,400 or so. And we also enjoy major 2,150 support. It's possible we pull back and test some of that. We'll have to see. We could get a sell the news moment when the Fed finally cuts rates, and that's where we could see something like that. To me, that would be a buying opportunity if we do see a pullback in some of these important markets on the rate cut news that is inevitably coming September 18th when the Fed meets. That's their next meeting. So gold at a record high. How about the U.S. dollar? Well, the U.S. dollar is finally, the fever is kind of breaking. We've had the dollar sitting up near the 106 resistance area now for a little bit. It's been pulling back since the beginning of the month of July. It's pulled back from 106 all the way down to about 102.50. Now that is providing some relief for assets, especially things, that are denominated in U.S. dollars, of course. Now, we got major support at 102, and then below that, we have major support in the 100 to 101 support level. Once we go below that, we would expect that the dollar could get back to the 90, 93.50, down to this area over the course of the next couple of years as those rate cuts begin to work their way through the market. So the dollar finally been, kind of bowing over, finally starting to break down. And again, this is not going to be a swift, fast decline in the dollar. That's not what we expect at all. We see a steady decline back to the 90s, somewhere in the 90s, maybe even a 93.50 support area over the next 12 to 18 months. If we look at the Russell 2000, that's another market we really like to follow. We're watching that 50-day. All of these markets trading right below their 50-day moving averages. The Russell 2000, which we follow with IWM, that's a small cap index. These are expected to do very well in the face of rate cuts. Many of them are very dependent upon lower rates, and so they'll be very excited to have lower rates because smaller companies, they don't have access to easy money as much as the big companies do. And so the interest rates, they're very dependent upon better interest rates. So the Russell 2000 very well poised as we move higher. Watch for a breakout on IWM above 225. That will be a multi-year breakout level. We're currently trading at about 207. That'll be a big deal for small caps. Silver also holding on to its 2650 support. We rebounded from that level last week, and we're continuing to hold above that level. However, we are trading below a falling 30-day moving average, which is a really key area on silver. That's currently up at that 29 to 29.50 range. That's a key area of resistance right now for silver. Let's see if we can break past that. Silver's still in good shape overall. It needs to hold that $26 to $27 resistance turn support area, but watch out for $29 resistance on the upside. Now, finally, let me just briefly talk about cryptocurrencies because, cryptos have not been immune from the market's movements as of late. Bitcoin and Ethereum have seen significant volatility. However, the underlying interest in blockchain and decentralized finance remains very strong. And so we continue to be very bullish on Bitcoin and Ethereum as we head into the remainder of this year and into next year. But as we look at the charts right now, we see Bitcoin struggling where? Similar to the S&P and the NASDAQ and the Russell 2000. It's trading right below the 50-day moving average. Again, this is another area that we're watching very closely on Bitcoin. Bitcoin also recently powered above its 250-day moving average on the daily. Very important area for Bitcoin investors to watch and for traders. We are kind of trading right now between the former peak, the all-time high of about 73,750 on Bitcoin, and the 50 weekly moving average on the weekly chart. This is another key area we're watching, kind of a tightness that's developing, but we are seeing volume improve. When we turn to Ethereum, we've also seen Ethereum really lose some ground. In the middle of July, it was trading at about 3,500. Now it's at about 2,600. So we've seen a pretty sharp fall. It fell all the way down to our 2125 area of support before rebounding, and we've seen it come back pretty decent from that. Again, right around $2,700 as we speak. We do expect more upside for Ethereum, especially in the wake of the recent approval of the Ethereum ETFs, the spot Ethereum ETFs. Those doing well, not as good as Bitcoin, of course, but we are seeing some good demand from those. And overall, we expect higher prices ahead for both Bitcoin and Ethereum into the end of the year and definitely into 2025. So in summary, while the markets have certainly been challenging lately, they continue to offer opportunities for astute investors who are willing to navigate these choppy markets. And those with an understanding of chart reading and understanding how trends work will have even better strategic insights to make better and informed decisions. Stick around for our final segment. I'll be sharing some concluding thoughts to help you keep your financial goals on track in the middle of all of this volatility. We'll be right back. All right, friends, welcome back to the final moments of today's broadcast. By the way, if you are interested in learning more about putting together a financial strategy, be sure to check out our free 5 levels of financial freedom right there on our website, followthemoney.com/5 levels. There you will find the step-by-step plan, the blueprint that my wife and I use to break free financially. We want to share that with you completely free right there on our website. It's also in our book, Bankruptcy of Our Nation. If you haven't read that book, I encourage you to pick up a copy. You can pick up a copy on our website or on Amazon or any good fine bookstore out there. Very important book talking about the real problems undergirding this economy here in the United States and specific strategies that you can implement to protect yourself. All right. So as we draw now to a close in this podcast episode today, I want to leave you with a final word. This is one that reverberates through time from one of America's founding fathers, and that's Benjamin Franklin. He once said, "Beware of little expenses. A small leak will sink a great ship." Now, this is a simple but very profound piece of advice, right? Because it's a cautionary reminder that it's often the small, overlooked expenses in our lives that can have the most detrimental impacts upon our financial health. Sure, we can have some seismic problems and big financial moments that could really, threaten to sink us. But for most of us, it's these tiny little decisions that we make throughout each day and each week and each month that can really have a detrimental impact upon our future finances. Every little expense we ignore, every little small leak we overlook can add up and pose a serious threat to the stability of our financial ship. So I encourage you to reflect upon your financial journey right now and just consider some of those leaks that might be hindering your progress. Are there some small daily purchases that are accumulating over the month that you could possibly cut out of your budget? Or maybe there's minimal savings going on in your life. Maybe you need to amplify your savings. That could significantly shore up your financial security. Either way, let's commit to plugging these leaks in our financial plan so that we can safeguard our financial vessel and set it on a course for a more prosperous and stable future. Don't make the goal just staying afloat, but actually to sail confidently towards your financial goals, despite the inevitable storms ahead. And that's just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and I'll see you right back here next time. Until then, God bless.
Contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any